Hello everyone, Ajinkya this side. Good evening to all. Thanks for joining in for this webinar. We are going to talk about our new asset, Wind Gold Bricks, right? And we will go through the details. First, we'll speak briefly about what our core investment philosophy is, and there is one question saying how long is this going presentation. So let me outline the let me outline the presentation and how it is going to be. Briefly, I'll talk for 5 minutes, and then Anshul will explain through the asset details for about 15 minutes, 10 to 15 minutes. So the presentation should be over within 15-20 minutes. Post that, if you have any questions that you want us to answer here, we'll be taking up all the questions, right? And many times it happens, some of the questions are very detailed and people want to get in touch personally with our education team. So you can schedule those calls also like after the session. And and if anyone is short on time with this or has something else to attend to, this session will be also put up on YouTube, right? And it will be available for everyone to go through at their own timelines, right? So today we are going to discuss this Wind Gold Bricks asset. This is a different asset. Till now we had brought on asset with one kind of loans that are underlying. So either it were gold loans or uh, property loans or vehicle loans, right? But this time, gold bricks is named for our property backed loans. Gold is for gold backed loan. So here we have tried to combine this portfolio. Why we have done so? Why is rating different compared to the other asset class? We are going to discuss in all these details, right? And if you have any questions, since these two things are very different, I would love everyone to pay attention to these two things. One is this a combined asset class. Some of the portfolio is backed by gold loans, some of the portfolio is backed by property loans. And second, in this asset, we have deliberately chosen not to enhance the rating to make it better for investor, which is very counterintuitive to even for us when I came across it for the first time, saying I would we when we decided, hey, let us not enhance the rating, let the rating be lower. That is even better for the investor. So why it is very interesting phenomena that we'll observe here. So Anshul will talk about it in detail, and I would love to answer any questions around it after that, after Anshul explains, right? So before we dive into details of this asset particularly, let us just look at like what is the basic philosophy or core investment philosophy at Wint Wealth, right? uh, Anshul, could we go to the next slide? Yeah. So our core investment philosophy is pretty simple. The asset should be secured, right? So they will be backed by solid collateral like gold, vehicles, or real estate, as we have seen in previous asset. They will deliver fixed return. So there will not be much of a correlation with market. Obviously, we correlate with index. Uh, that is from a tax arbitrage point of view. But beyond that, in general, if the market falls by 20%, 30%, these assets don't have any impact. And that is the kind of philosophy in general at Wint Wealth, is to develop assets which are not related to market, right? My market means equity market mainly. And third is, again and again we have seen entities going bankrupt. So where we create this pool of underlying collateral back loan, we also make sure that this pool is bankruptcy remote. That means if the entity goes bankrupt, the pool is not part of bankruptcy proceeding, which can take years. The pool recovery starts immediately, and we have full right over that pool and exclusive right over that pool, right? And that's the basic philosophy with which we have developed our past asset, and we will also work on future assets, right? Now, going to the next slide, as most of you have known, there have been welcome regulatory changes. These changes are basically like two major changes. One is, earlier for any public issue, right? For individual investors, SEBI wants to go through a route of public issues. But for public issues, earlier minimum issue size requirement was 100 crore. And any entity where the yield is higher, they like most of these entities didn't need that kind of capital at one go, right? So those kind of public issues were out of reach, and those entities were also out of reach for retail investors. Now that requirement is gone, so even a 10 crore can happen through public issues, and we are bringing up many public issues, right? And other thing is that has also happened for private issue. Now the minimum transaction size is 10 lakh, and this being private issue, the minimum transaction size will be slightly above 10 lakh, right? So this is I guess we have spoken about this before the asset class. We have done one webinar specifically on the regulatory change. It is there available on YouTube. If anybody is interested in specifically knowing the details, feel free to visit that webinar, right? So this being a private transaction, the minimum issues ticket minimum investment size will be more than 10 lakh. We are also working on many public issues, and the first one will come in October, right? And then we have lined up many public issues, right? And in public issue, even though minimum ticket size is going to be lower, people can invest higher amounts, right? There is no bar as such. I mean, the bar will be as like it will be in the range of 50 lakh, right? Now I'll request Anshul to talk about the asset structure and specifically details about this asset. Over to you, Anshul.
Thanks, Ajinge. Thanks everyone for attending this webinar. So even though a lot of us would be aware of how a covered bond works, but still a quick recap for a few of our newer investors who might be attending this webinar. So in a covered bond, the covered bond investor gets dual recourse. One is on the issuer or the borrower, which is issuing the NCD, and second is on the underlying collateral. The underlying collateral can be a pool of gold loans, vehicle loans, property loans, etc. That's the second level of security. Legally, how this is structured is NBFC issues bonds to the investors. In parallel, SPV, a special purpose vehicle, is created. The underlying pool of collateral is sold to the SPV, is assigned to the SPV, and SPV in turn guarantees the bond. So in usual circumstances, if NBFC is performing well, on the maturity date, NBFC will repay back the interest and the principal. In a hypothetical scenario that NBFC has gone bankrupt, has defaulted, the second level of security, which is the SPV, steps in, and the collections coming from the underlying pool of gold loans, property loans, etc., start flowing to the investor. That's broadly how a typical covered bond works. A trustee, SEBI accredited trustee, is appointed for each transaction for each covered bond, which manages the flow of money and the operations of the entire transaction. A quick recap of MLDs also. MLDs or market linked debentures. These are essentially bonds or debentures whose coupon is linked to a reference index. Index can be Sensex, Nifty, or any other similar index. The benefit of doing this is, since the payout to the investors is linked to a equity index, which is uncertain, the taxation for the investor becomes similar to equity taxation, which means if you are investing in a covered MLD with a tenor of more than 1 year, the taxation is at par with equity, which is LTCG, that is 10%. On the other hand, for regular bonds, the taxation is same as the income slab rate, which means if someone is in the 30% tax bracket, in a regular covered bond, in a regular debenture, the taxation rate will be 30%, while in case of MLDs, since the payout is linked to a equity index, the taxation becomes 10%. And how this linkage is done is for this transaction, the Sensex is slightly above 50,000. What we have said is at the end of 15 months, which is the maturity of the MLD of this covered bond, if Sensex falls by more than 80%, then the investor only gets back principal. However, if Sensex remains more than 11,300 levels, investor gets back the principal along with the 11% coupon rate. So this, as you can see, the linkage is slightly notional. The probability of Sensex falling to such a falling by such steep levels is minuscule. but you can in parallel get the taxation benefit. So that's the benefit of a MLD. It provides taxation relief for the investors. Coming to the NBFC,
Anshul,
which is, yes.
Anshul, just disturbing you. There are some questions coming up. Since the number of questions today are less, rather than answering them in written, I and Anshul will cover each of the question at the last. Like as the presentation is over, we'll cover the every question and we'll answer it live. So the questions may not get answered here, but don't worry, we'll answer them live. Anshul, over to you.
Sure. Now, coming to the NBFC, which is issuing this covered MLD, the NBFC name is Dhanvarsha. It's a listed entity. The entity is specializing in gold loans and SME loans. Within SME, entity has both secured and unsecured portfolio. However, for our transaction, we have only taken a secured portion of their portfolio comprising of gold loans and property loans. These property loans are fairly granular, given to SMEs, and these loans, like the name suggests, is backed by property. Coming to the size of the NBFC, NBFC has over past 12 months raised approximately 110 crores worth of equity, taking the overall equity size of entity to roughly 160 crores. The portfolio as on June is around 130 CR, and entity is growing at a fast pace. Having said that, the leverage of the entity, which is the debt to equity ratio, is still under 1 times. And if you look at the industry standard for NBFCs, most of the NBFCs, they tend to have a leverage which is above 3 times. For us as debt investors, lower the leverage, better is the credit quality. Because any losses in entity's portfolio can be taken care by the equity. So for investors, lower the leverage, better it is. Hence, using that benchmark, if we look at Dhanvarsha, since leverage is below 1x and our exposure is only 15 months, we don't expect over the tenure of our facility leverage to go beyond 3x. Hence, from that point of view, it's a strong credit comfort for us for covered bond investors. If we look at the equity investors in the entity, it includes Aviator Emerging Market Fund. Nomura Holdings has taken a small stake in the entity, and some renowned hedge fund investors like Porter Collins and Vincent Daniels, they have also taken equity in the company. Entities debt investors are fairly diversified, and the number is growing every month almost. It already has 10 plus lenders, including large lenders like NABARD, SBI, HDFC, and so on. The collection efficiency of the entity has been strong, even during second wave of COVID. The NPA numbers have consistently remained below 3%. And specifically, if we talk about the gold portfolio, the NPA numbers have been zero there, since the loans are backed by gold collateral. In case if a borrower is defaulting, not paying the repayments on time, after a certain number of days, the entity liquidates the gold and the loan is closed. Coming to our live transaction, like Ajinkya mentioned, it's a privately placed transaction. So the minimum investment size will be 10 lakhs. The entity is listed on BSE. The tenure of the transaction is only 15 months. So the transaction will mature by December of next year. The returns for the investors are 11%. And like earlier transactions, you can the units will directly come in your demat account. So there is no counterparty risk of Wint as a platform. One interesting point here is the asset has a rating of BBB. If you notice our earlier assets, they used to have a credit enhanced rating, but there have been some changes in the models of rating agencies. And as per those changes, if we want to have dual recourse at every point of time, which means if you look at our earlier transactions, if entity did not honor or did not repay money at the end of 15 months, that resulted in a trigger event, post which the repayments from the pool used to kick in, which used to take around 1 to 2 years. Now we want entity to be taken to court at the end of 15 months only, which means they were supposed to pay the money at the end of 15 months, and if they miss the payment, they should be taken to court. And in parallel, my second level of security should kick in. But due to these changes in the models of rating agencies, what rating agencies are saying is if you want to take entity to court, you need to call it a event of default. Even though you have second level of security, you still need to call it a event of default and then take entity to court. Because of this change, for covered bonds, the ratings are becoming at par with standalone rating of the entity. In our transaction, since Dhanvarsha is triple B rated, even the covered bonds are getting triple B rating. If we give up this right to take entity to court, then we can get an enhanced rating. But that weakens the structure to a certain extent, since the repayments from the underlying pool will come over a period of 4 to 6 years, since the underlying pool also has property loans, which are longer tenure in nature. Hence, we don't want to give up the right to take entity to court if they don't repay at the end of 15 months. A consequence of that is the rating is capped at entity rating, which is triple B. The underlying logic behind these changes is when rating agencies assign a rating to any instrument, we as investors think they are evaluating the risk for the investor. However, in their models, they estimate probability of default and not the ultimate loss for the investor. A common example for this is if any entity, whether it issues a senior secured bond, a unsecured bond, or a subordinate bond, which is like very risky, all three bonds get the same rating. Even though we know a senior secured bond will see a lot of recovery after a default has taken place, because after all, the senior secured bond is backed by a security. But rating agencies in their model, since they are only estimating probability of default and not the recovery, all these three bonds, they get the same rating, even though senior secured bond are much less riskier compared to a subordinate bond. And these are some of the inefficiencies which are there in their model. But having said that, we don't want to give up that right to take entity to court. So we are fine with a lower rating, but we want a tighter structure. Yeah, in terms of the second level of security which is there, which is our underlying pool, it's a combo deal. Around 75% of the underlying loans consists of gold loans, and the balance are property loans. Total number of loans are 2004. Both types of loans are fairly granular. The average ticket size of gold loans is 80,000, and for property loans it's slightly above 26 lakhs. The security cover is 1.25 times the bond amount. Additionally, we also have 7% cash collateral, which is placed as fixed deposit in a bank, and trustee has full rights over that cash collateral in case of any defaults. This transaction has certain risks which all the investors should note. First is all these structures are illiquid in nature, which means if you are investing in any of our assets, invest with the mindset to hold till maturity. For this transaction, tenor is 15 months. Park only that much capital which you can deploy for 15 months, which means don't park your liquid capital, don't park your emergency funds in these assets. Having said that, in case if any investor wants to exit the transaction before 15 months, the investor can reach out to us. We can reach out to other investors on our platform and see if there is a willing buyer available. If such a willing buyer is there, we can do the matchmaking and facilitate this early exit. But and normally such secondary exits have been given in the past. But in extreme scenarios like demonetization, COVID, etc., when a lot of investors might be wanting to have early exits, such secondary liquidity may not be there. So invest in these assets with the mindset of holding till maturity. Second risk in all these transactions is credit risk. Even though a lot of credit risk has been mitigated, but these are not zero risk exposures. These are not a replacement for your government bonds or fixed deposits. Theoretically, both these have almost negligible risk since there is government backing for FDs and government bonds. In our transactions, even though there are two levels of security, if both levels of security collapse, there can be a shortfall in repayment to the investors. We have strong mitigants in place at a NBFC level. The leverage is low, and our second level of security is backed by gold and property. But still, do note that this is not a zero risk exposure. Third is the fraud risk. What if the data shared by NBFC is fake and the underlying loans do not exist? To mitigate these risks, we run some checks on the data that NBFC shares with us. For example, all the loans which are there in the SPV, in the collateral, we run a KYC check on all the end borrowers using a PAN number. In case of gold, a random sample audit is done, in which case our team visits the branches of the NBFC, checks the quality of and presence of gold collateral in their branches. In case of property loans, 100% audit of these property loans has been done. The details of each property has been cross-verified on government portals. So these checks helps us mitigate the fraud risk in the transaction. Just a quick recap of our earlier assets. Like you would know, we did our this is our seventh asset. We have done a gold transaction in June and a property transaction in July. And this transaction is a combo deal backed by gold, both gold and property loans. Yeah, that's it on the structure and the transaction. We'll be now taking any questions that you might have.
Hey, thanks, Anshul. Yes, sorry for my background. It is little dark. There are the questions number have increased. So what we'll do is our team will start answering basic questions, general related questions to either Wint, general asset structure. Whatever question are here related to this asset particular, that we will take live, right? Again, one question I just want to reiterate what Anshul told, right? About why the rating is not enhanced, even if there is a dual recourse. So first we have to understand. I'll try to answer it again, and if there is any slight change, slight confusion, I'll answer it again, right? First, you have to understand how ratings are given, right? Let us say an unsecured bond is issued by a AAA rated NBFC. That bond will be that unsecured bond will be still rated as AAA. And let us say a covered bond is issued by NBFC, which is rated BBB. That bond rating could be BBB, right? Uh, the thing is that rating measures probability of default. That means what is the chances that this NBFC will honor its commitment on the due date of the bond maturity date, right? It doesn't actually measure what happens if the NBFC is not able to honor, right? So if it is unsecured bond of a AAA rated NBFC, let us say, right, the chances of that NBFC going bankrupt and not honoring that commitment is very low. But should it happen, if it happens, then what are the chances of recovering that money? They're absolutely almost zero. uh, not exactly zero, but absolutely zero, because the NBFC has gone bankrupt, the loan is unsecured, right? When NBFC goes bankrupt, there are some things that have happened, and the secure lenders will have first charge, right? So what they measure actually is liquidity risk, not credit risk. What as an investor we would optimize for is credit risk. Money should not be lost. In the If I have to make a trade-off between liquidity risk and credit risk, I will always want to minimize the credit risk, right? Not liquidity risk. Because if money comes late, that's okay. But still, my first priority as an investor is to make sure that my money is safe, right? So this is how rating works. Now in this scenario, there are so this bond has a maturity of 15 months, right? However, the underlying portfolio have and underlying loans will have a maturity of 6 or 8 months more, right? So the rating depends, when are you measuring the default? Are you measuring it after 15 months, or are you measuring at the end of the underlying pool loans, right? So if I am measuring default at the 15th month, then I will assume that NBFC liability should be there because these loans may not pay on the same day. But if I'm measuring probability at the end of, let's say, 24 months or 27 months, when the underlying pool loans will mature, then the probability of default is going to be very low. So if I choose to measure the probability of default at the end of 24 or 27 months, then the rating will be enhanced because the probability is low. Remember, rating is not measuring credit risk, it is measuring liquidity risk, right? But if I choose to measure that risk probability of default at 15 months, the rating will not be enhanced. Now, if I decide to get a rating for 24 months or 27 months, right, then I cannot take the NBFC hold, like I cannot ask the NBFC money before those 24 or 27 months. If I make the rating at 15 months, on 15 months I can ask the NBFC pay my money, and if they don't, then I have rights to, in addition to the pool that I have rights on the NBFC equity, etc. So if anything were to happen by 15th month, and if I have to wait till 27 months, all will be gone, right? So that actual cover of NBFC would not make sense. Therefore, we made this conscious choice of going for low rating, right? So I hope this makes it clear, right? Okay. So with this, now we'll move to the next question. Yeah, in this slide on structure of covered bond, there is a line saying that SPV gives unconditional and irrevocable guarantee to NBFCs. Is this guarantee for NBFCs or for investors? So this guarantee is given for the bond, and in turn that is for investors and not for NBFC. Right, Anshul?
Yes, guarantee is in the favor of investors, and what they are guaranteeing is the repayment due from the NBFC. That tomorrow, if NBFC were to default, SPV will step in and start making the payments to the investors.
Yeah. Great. Is there a tax ruling available for tax rate that you are mentioning, Anshul? This is, I guess, MLD related question.
All right. So there hasn't been any ruling, but what the underlying logic that tax consultants have given is, since the underlying payment is uncertain and linked to a index which is fluctuating, hence the investment in such an asset, the gains that are coming will be treated as capital gains and not interest income. And since these are capital gains, the taxation will be 10% if you hold for more than 1 year. But
Understood.
there is no specific ruling given by income tax authorities on MLDs. This is the view that market is taking and the tax consultants, including Big Four, are taking.
And does Wintwealth manage the collateral pool? How frequently the collateral pool is adjusted?
Yeah. So Wint Wealth cherry picks the loans which will become part of the collateral pool. The legal ownership of the underlying pool remains with the SPV, which is managed by the trustee. The pool is adjusted on a monthly basis. However, the criteria that will determine what kind of loans can be included in the pool is defined upfront on the settlement date. So any loans which are added in that pool will be basis that criteria which has been predefined. Wind wealth on these loans which are getting added on a monthly basis, we continue to do our checks, similar checks which I discussed in our presentation, that were done for the initial set of pools, which means the KYCs for new borrowers will be validated. In case of property loans, verification of property will be done with the government database. Yeah, so our audit cherry picking will continue on a continuous basis, and the pool will keep on getting adjusted on a monthly basis.
Yeah. Will the value of collateral decrease over time since repayments will go to NBFC and not to the SPV? Like, what if the NBFC goes into bankrupt in the last month?
Yes, the value of collateral will remain the same. The adjustment that I was speaking about in my previous answer is mostly for this kind of repayments and prepayments. Let's say on day zero, we had 2000 loans, and at the end of month one, 10 loans prepaid. Now, NBFC will give incremental 10 loans to take the collateral value to what it was on the settlement date. So, at all points of time, the collateral value will remain at least 1.25 times the outstanding bond value.
Understood. The next question is, why are advances lower than net worth even without including loan? Is the rest liquidity?
No, this is primarily because of recent equity raise that entity has done. So entity has done two rounds of equity raise uh, over past 10 months. First was a 50 crore equity raise that they did in December, and then was a 60 crore equity raise that they did in April. And this equity that they have raised is getting deployed. Because of lockdown, the disbursements were slightly lower, but now the disbursements have picked up steam, and the portfolio size is rising month on month.
Yeah, thanks. If I understood correctly, over the period of 15 months, you expect debt to equity ratio rise from 0.7 to about 3.
Yes, because of equity raise, debt to equity ratio is very low. I mean, if you look at other NBFCs in the market, the industry average will be between 3 to 5 times. For this entity, it is uh, very low. It's like almost at an extreme level. Now, since entity has begun a disbursement and next equity raise might take some time, the leverage of this entity will start increasing. It may not go as high as 3 times, but it will definitely go beyond 1.5 times over medium term.
Understood. There is one question is, can a HUF or corporate invest in it? What are the limits? Yes, they can invest. The limits, there are no limits as such. Are there options of liquidity in between? Uh, yes, we help secondary liquidity only if there is a buyer. In fact, when the asset gets subscribed, we open the waiting list and many people register in waiting list. So if you want to sell, we just call people in the waiting list, and if anyone of them is willing to buy, then we facilitate that transaction. However, we do not guarantee secondary liquidity, right? So there might be a scenario where you are not able to exit and you have to wait for the buyer or for the end maturity to receive your money. Uh, did Dhanvarsha invested in DHFL and that property is given as collateral? Anshul,
No, nothing like that.
yeah, okay. Yeah. So, who is auditor of this NBFC? Who has done the due diligence of the underlying pool? Name that external agency or auditing fund.
Yeah, the auditor for the entity is Haribhakti and Co. It's classified amongst like big six auditors in the country, and some of the other large corporates also have Haribhakti as their internal auditor.
Yes. How the collateral value is 2.7x, and one more question regarding to that was the loans outstanding are 19.2 and how's collateral value 2.x. Can you just
Right. So if we look at the security collateral which is there in the transaction, like you correctly pointed out, it is 1.25 times the bond amount. If the bond amount is 15 CR, the outstanding principal value of the loans which are there in the collateral will be roughly 19 to 20 CR. Now, each loan is in turn backed by either gold or property. When entity gives out gold loans for 100 rupee gold collateral, the maximum loan which is given is 75. That's the maximum LTV threshold. LTV is loan to value ratio. For 100 rupee gold, if 75 rupee worth of loan is being given, the LTV becomes 75%. Now for our gold collateral, the LTV, average LTV is between 70 to 75%. So the value of the gold backing this collateral is almost 1.3 times the principal value of the loans. The same LTV is much lower for property loans. So if we add the value of the property and value of the gold, it is much beyond 1.25 times the principal amount. On top of that, there is 7% cash also, hard cash, which is lying in the bank and given as collateral for the transaction.
Uh, Please explain the liquidation process in case the NBFC defaults, and how much time will it take to make due payments, and how will the amount be calculated?
Right. So the sequence of events will be in case, let's say, entity defaults 1 month down the line. So whatever money is coming from the underlying pool will start flowing to the investors. In our transaction, since 75% of the loans are gold loans, the tenor of these loans is normally less than 1 year. So 75% of the repayments should come within 1 year. Additionally, there is 7% cash also, which will be liquidated and returned to the investors. So ballpark 82% will come from these two things. In fact, this won't be 75%. It will be 1.25 times 75%, since our cover is 1.25x. So if we look at gold loans and cash collateral, it will be roughly 95% of the capital should come from these two sources. Additionally, the balance 25% property loans also will start repaying. So we expect net within 12 to 24 months, all the repayments from the pool should be adequate to repay back the investors. In parallel, trustee has full rights to sell the underlying pool of loans in one shot to any institutional investor. If these loans are performing well, there will be buyers in the market who will be ready to purchase this pool at one go. If such an institutional buyer comes forward and trustee is able to find such an institutional investor, then in one shot the entire bond will be repaid. Having said that, if such a buyer is not there, uh, investors can budget 12 to 24 months for the capital to come back from the underlying pool of loans.
Okay. Yes. There is one question: shouldn't bond rating rise due to dual recourse? I don't quite understand how we taking company to court is linked to bond rating. I explained this, right? This is when this is about whether you give up right to take entity early, right? If you give up that right, rating would be enhanced. But I explained this in detail. If it is again still unanswered, please free to send that question again, and we'll take it again. Till now, did you face any credit trigger event with any of the NBFCs you are working with where underlying NBFC has defaulted?
No, till now for any of our for none of our transaction we have faced any trigger event, and none of our NBFCs are defaulted.
Sure. Currently, the lenders of this NBFC should be having charge of these underlying assets. So we as investors shall be subservient or secondary to them.
No, these assets are unencumbered, which means no lender has a charge on these assets, and these assets are earmarked only for our transaction. So these are unencumbered assets.
Understood. Great. Who will have custody of this collateral gold?
See, there are two things here: the legal custody of the underlying gold collateral, etc., and the property loans remains with the trustee, who acts in behalf of the investors. From an operational point of view, the hard collateral is still in entities branches, and it's more from an operational point of view because the end borrower of gold loan they will come almost on a daily basis, repay back their loan, and would want immediate possession of the gold collateral which they had given as security while taking the gold loan. So trustee doesn't have physical presence across India. It is entities branches which are spread across different states where borrowers are there. So for operational purpose, the physical collateral remains in entities branches, but legal rights, full legal rights, are with the trustee, which acts on behalf of the investors.
Thanks. So we are now told that mode of transfer of funds is not through NEFT or wallet. Please explain other means that were communicated to us. So I'll take this question. So now transaction can happen through two processes. One is on the exchange. So you will place a buy order, we'll place sell order, and you'll be able to get it. How you do it is you transfer your money into your trading account, demat account, broker account, right? If that is not happening, because at many brokers these bonds are not part of their listing process, then the transaction will happen through ICCL. ICCL is another settlement agency. So how things work with ICCL is, let us say you decide to buy bonds from Wint. Now you pay the money to ICCL. It is Indian Clearing Corporation Limited, and we give those units to ICCL, and ICCL takes care the transaction is executed. This actually reduces the counterparty risk. So what is a counterparty risk is not in case of Wintwell, but it might happen that you are dealing with some individual and you tell him, I will give you 10 lakh and you transfer me the unit. Now, what if that individual actually takes the money but doesn't transfer unit, right? So there is this risk that exists. Through ICCL, that risk is eliminated. And precisely for this reason, the regulator has said all the transactions should either happen on exchange or through ICCL. That is to protect the investor. We really welcome this step. And the transactions flow is also smooth. So you would require to transfer money to ICCL. Okay. Now the next question is, how is underlying protected in case of entities taken over by another entity on default or because of default or bankruptcy? In IBC, entire process halts and nothing can be taken out for bankruptcy proceedings.
All right, it's a good question, and frankly, that's where the beauty of a covered bond also lies. If an entity goes into bankruptcy, all the assets that the defaulting borrower owns becomes part of the bankruptcy proceedings. In case of covered bonds, the underlying collateral which is there is assigned or sold to a SPV or third party. Since the ownership transfer is taking place of the underlying collateral to a third party, the NBFC no longer owns these gold loans or property loans. Hence, these loans which are there in our transaction will not become a part of the bankruptcy proceeding of the NBFC. And any repayments that come from these gold loans or property loans will directly go to the covered bond investors. And this is I think the most important difference between a covered bond and a regular secured bond. In a regular secured bond, the ownership of the collateral remains with the NBFC. Hence, the security also becomes part of the bankruptcy proceeding of the borrower. In a covered bond, since the ownership has been transferred, these loans will not become part of the bankruptcy proceedings of the NBFC.
Okay, thank you. Yes. Who will take care of recovery if NBFC defaults, and who will bear the cost associated to it?
All right. So the trustee will manage the recovery proceeding. One thing is if NBFC has defaulted, there are two scenarios. Like NBFC has defaulted, but branches are still operational. In which case, entity is obligated to transfer any collections that happen from the underlying pool of loans to the trustee, and trustee in turn will make the outward transfer to the investors. Now, let's say entity has also wound up operations or is not doing the servicing properly. So trustee will find a alternate servicer which will step in, reach out to the borrowers and start doing the collections. And in India now, like there are multiple alternate services. We at Wintwealth have also done a tie-up with a alternate servicer, which will be on a standby mode for all our transactions, which means if any of our transactions were to see such an event that NBFC has defaulted or is not doing servicing properly, that alternate servicer can step in and start doing the collections from that point of time.
Who will bear the cost? Yeah.
The cost of such a replacement will be borne from the underlying pool. But since our underlying pool itself has a lot of cushion, there is 25% extra pool which is there, along with the 7% cash collateral. Even after paying cost of a alternate servicer, the repayments from the pool should be adequate to fully repay the investors.
Yeah. Thanks, Anshul. So next question is, what is common or difference between this asset and the previous asset that Wint had from the same NBFC?
Right. So the main difference is in the underlying pool. Our last transaction had completely 100% gold loans. In this transaction, there are few property loans also which have been included. The ratio is almost 75 to 80% gold loans are there, and balance 20 to 25% property loans are there. Other than that, the transaction broadly remains the same. Like Ajinkya mentioned, the rating difference is there due to changes in rating models, etc. So we suggest that if investors have already invested in their last Dhanvarsha transaction, they can avoid taking exposure in this transaction, since we don't want investors to have too much concentration in a single kind of underlying, in a single NBFC.
Yeah. One thing I want to mention here is there is literally no change in terms of structure from the previous assets that we did with Dhanvarsha or with other NBFCs. The rating agencies have changed their methodology, right? So in terms of structure, it is not that structure was weaker earlier or it has become weaker now. It was always a watertight structure for previous asset and for this asset. Anshul, the next question, who is the trustee?
Trustee is Catalyst Trusteeship Limited.
In regards to collateral, will you get the loan worth 1.25x of the loan amount? Or in addition also collateral which is submitted by the customer who has taken loan from the NBFC?
So 1.25 times is the principal value of the loans which are there in the underlying collateral. Like I mentioned, normally the LTV is less than 100%, at max 75% for gold loans. So the value of the collateral, which is backing the loan, will be much higher. I hope I was able to answer.
No, so I guess the question was really regarding you just do the investor just own the loans or the underlying collateral? When you own the loan, you also own the right to liquidate the underlying collateral. So that's very clear. It is not that if the borrower doesn't pay, the collateral will be liquidated and that money will go to these investors only, you investors. So that is absolutely clear. So you have right over the loan and you have right over the liquidating the collateral, right? How is prepayment risk mitigated? If borrowers of these property or gold loans prepay their loans, does that mean the MLD investors do not get their due coupon?
Right, like I discussed earlier, we do a monthly replenishment of the underlying pool. Any part repayments or any full prepayments that happen in the underlying pool are utilized to add incremental loans in the collateral pool. So let's say we are starting with 2000 loans on settlement date. Let's say 10 loans have prepaid at the end of month one. Entity will add fresh 10 loans as per our criteria, which is there in the transaction, to replenish this rundown in the underlying collateral. So at all points of time during the tenure of our covered bond, the security value will be at least 1.25 times the outstanding liability under the bond.
What is the ratio of gold loans and property loans in this asset pool?
It's roughly 3:1, where gold loans are roughly 75% and remaining are property loans.
Yeah. What will be the unit price that we can buy or sell? Is the unit price decided daily? Yes, it is pre-decided. Every day the price reflects change, so that 11 yearly 11% is the interest rate, right? So every day some interest will accrue, and based on that accrued interest, the price will change. But it is not randomly decided between buyer and seller on daily basis. Right? So it will, like, I can definitely tell you what the pricing sell price is going to be from our end, let's say 7 days or 10 days or 5 days down the line. Also, when gold price falling below the LTV in our collateral, what will be the mitigation options?
Right. So the gold loans that NBFCs give, these are demand loans, which means, let's say a customer walked in the branch of a NBFC and deposited 1 lakh worth of gold, and NBFC gave a loan of 75,000, meaning LTV of 75%. Now it so happens that the value of the gold falls by 10% the very next day. So the LTV in the exposure to the end borrower maybe has gone from 75% to now 85%. NBFC in such a scenario will ask for incremental gold from the customer, or ask the borrower to prepay some portion of the loan so that LTV again falls down to 75%. NBFC has full right over making such a demand, and we have seen in the past, wherever there have been huge fluctuations in the prices of gold, NBFCs have either asked borrowers to pledge additional gold collateral or prepay their outstanding loan to a certain extent so that LTV falls back to 75%.
Understood. Uh, our risk is fraud risk. We fear of fraud risk. Please advise how do the same is mitigated. Post mitigation place, how confident are we that there won't be a fraud?
Right. So fraud risk, I think it's an important risk element in any transaction. So each asset class has its own kind of frauds which can happen. For example, in case of gold, it can so happen entity has told us that gold collateral is stored in their branches, but that collateral may not be there. Same can happen for property loans, that entity can say we gave loans, 5 loans to these 5 borrowers, and these loans are backed by these 5 properties. So at Wint Wealth, we try to do audits and validate the data that NBFCs are sharing with us with third parties. For example, for all the property loans which are there in our transaction, we have verified the properties with government portal. This portal is called as CERSAI, CERSAI. In this portal, whenever a NBFC gives loan to the borrower, details of the property are recorded and a mortgage or hypothecation is created in this portal. So we have verified the data that NBFC has shared with us with the details on this government portal, and have verified that these properties are actually there, and Dhanvarsha has a mortgage over these properties. So in case of property loans, this reconciliation audit is quite easy since we have this government database. In case of gold loans, such digital data points do not exist, because in a gold loan, the underlying is physical gold which is stored in vaults in entities branches. And since these digital data points are not there, to reduce, mitigate fraud risk, we do a random in-person physical audit. And these audits keep on happening on a quarterly basis for gold loans. But having said that, since the branches are spread across the country, Dhanvarsha has a number of branches, and the pool in our transaction is coming from multiple states. We have done a sample audit of covering 3 branches, and 100% of the loans from those 3 branches have been audited, verified by us. In our future quarterly audits, we'll be auditing other branches also. And over the course of the transaction, we'll try to increase this sample size. So gold has been verified and audited by doing these in-person physical audits. And for property loans, we have these digital data points via CERSAI portal, using which we have done the audit. The second level of audit that we have done is for all the borrowers in our pool. We have verified their existence using the KYC IDs of the end borrowers. These IDs can be PAN, voter ID, etc. So using those KYC IDs, we have matched that the borrower actually exists and the details about the borrower that entity is sharing with us. They are telling with the data which is there in, let's say, NSDL database or other databases.
Understood. Yes. How much of these underlying loans are irregular but not NPA today?
So all these loans are current as on date. It can so happen that at the point of inclusion of these loans, they were current, but let's say they missed EMI after the inclusion. So we have a condition in our transaction structuring that any loan which becomes NPA, which misses 3 EMIs, entity will replace that loan with a performing loan, with a current loan. But as on settlement date, 100% of the loans are current, are paying on time.
Understood. Yes. Uh, do you have a right to refrain company to raise further debt or to take uh, leverage ratio over current 0.7x?
No, we don't have such a right, and such rights are not given by any borrower in the market. Such restrictive rights, I would say. But what we have done is RBI allows NBFCs to have leverage up to almost 7x, which means if a entity has X has equity of X rupees, NBFCs can take debt to equity ratio up to almost 7 times. In our transaction, we have been slightly more restrictive and have placed a covenant that such a leverage cannot go beyond 5 times. This is captured by a CRAR number, capital adequacy ratio. Regulations permit NBFCs to have CRAR as low as 15%. For this transaction, we have kept the covenant as 20%. So we have been even more restrictive than what the regulator allows. But restricting entity to leverage as low as 0.7x, it's like practically not possible.
Isn't collateral value close to 40 crore? Why is collateral not mentioned as 1.3? Why is collateral value mentioned as 1.3x of the asset? Should
Right.
be 2.5x. No?
Right. So what we are saying is the principal portion of the loans will be at least 1.25 times, and 7% cash is obviously there. This takes it up to 1.32 times. But the value of the underlying gold and property will be much higher. Now the condition says that, and since the pool will change on a monthly basis, the condition we have kept is the value of the outstanding principal will need to be 1.25 times at all points of time. The collateral value might fluctuate, but principal outstanding of the underlying loans has to be at least 1.25 times.
Sure. Thanks, Anshul. If the end borrower defaults, who is at the risk? NBFC, Wint, or the investor?
So NBFC is fully liable to repay the covered MLD, irrespective of what happens to the underlying borrowers. Even if 100% of the borrowers default, NBFC has complete obligation to honor the repayment. And that's the beauty of covered bond. You have dual recourse. One is on the underlying pool, second is on the entity. As long as either of these two layers are performing well, you will still get back your repayments. So to answer again, irrespective of what happens to the underlying borrowers, NBFC still has to make the repayment. In that sense, NBFC is the one bearing the loss.
Yes. Thanks, Anshul. How do you compare this product with credit risk debt fund, which also invest in AA rated bond and give about 9 to 10% return? Anshul, also please clarify. I mean, particularly about this question: do they really invest in AA rated bond, and do they give that kind of higher returns in today's market?
See, I think this 9 to 10% return, it's not coming because of yield in the bond, because interest rates in the economy have fallen. So hence, because of these M2M gains, the yields, historical yields on credit risk funds have increased. In few cases, it has gone up to 9% also, like you mentioned. But if you look at the yield in the portfolio, it's somewhere between 6.5 to at max 7.5%. So going forward, since these M2M gains will not be there, and in fact, you might have negative M2M as the interest rate in the economy increases. These returns, even from credit mutual funds, one should not expect these kind of returns. The return expectation as a category in credit funds should be between 7 to, let's say, 8.5%.
Yeah.
Secondly, a lot of these credit funds, they also invest in similar kind of entities, can be triple B rated, A category, etc. So yeah, not all exposure of credit funds will be in AAA or AA rated
Yeah.
papers.
And yeah, as far as I know, the 1 year return of most of the credit fund is the pure return, interest return is in the range of 7%. If you remove the return because of interest rate change. Anshul, now the question, coming back to the question, how do you compare this product with credit risk debt fund?
Uh, See, ultimately, we need to look at the underlying and not the product per se. Like I said, even credit risk funds invest in a lot of R entities. Kokta Finance, for example, it's a NBFC which was there on our platform in March and April. Few credit funds have also taken exposure in Kokta Finance. Uh, but the benefit of a platform like Wint is you as an investor have full control on what kind of underlying exposures you want to take. You in turn can build a small mutual fund in your portfolio by cherry picking what kind of exposures should be there in your portfolio. Credit funds, like we know, they are taking exposure in a lot of other papers also, which we may not want in our portfolio. For example, some credit funds might have taken exposure in perpetual bond, which I as an investor don't want to have in my portfolio. The benefit of you choosing which kind of bonds you want to take is such kind of exposures you can avoid, and you can directly take exposures in the kind of bonds, in the kind of entities that you feel comfortable with.
Yeah. And just from a structure point of view, at this point at least, any debt mutual fund is much more diversified, right, in terms of exposure. Uh, because you are investing in individual bond, that concentration risk is higher. We are also trying to solve that problem, and in future we will be solving it. But from liquidity point of view and from diversification point of view, any debt mutual fund is better. But in terms of credit risk, actual money, like how safe is money, and in terms of returns, the our products could be better. Obviously we are we strongly believe in our products, therefore we are bringing it on a platform. So our views will be little bit biased. So uh, but that doesn't mean that we will go extra mile to say anything. Whatever is there out, we believe in educating the investor and letting them take the call, right? uh, Please explain a case or circumstance wherein the principal amount recovery is at the risk.
So, in a scenario that both NBFC has defaulted and there are massive defaults happening in the underlying pool, even though we have a 25% cushion, let's say there are massive losses happening in the underlying pool, and even after liquidating the collateral, trustee is not able to recover back the money. Let's say some fraud has happened, which we could not spot in our audit, etc. In such scenarios, yes, your principal also can be at risk. And like I mentioned, these are not zero risk products, and definitely not a alternative for government bonds or fixed deposits.
Yes. If we want to invest less than 10 lakh, when will we get the chance? We are bringing in many public issues. In public issue, the minimum investment will be 10,000, right? Till the public issues don't come. In private issue, because of the regulatory reasons, the minimum investment ticket size will be in the range of 10 lakh rupees. What will be the return on investment of 10 lakh at the end of 15 months? Uh, Maybe Pranav or Indrajit can answer this in writing. I don't have exact number on my mind. It will be 11% XIRR. The next question is, what is the NIM of Dhanvarsha, and do they have positive ALM in smaller time buckets, less than 12 months? This is a very intelligent question. Even I would love to know that.
Yeah, the ALM is positive across the buckets. It's primarily because of two things. One is like if you look at the underlying portfolio of the entity, it's primarily composed of low tenor assets, which are mostly gold loans. And gold loans, like we know, have a tenor between 6 to 12 months. While the liabilities that Dhanvarsha is raising, it's broadly between 15 months to 3 years. So assets are repaying much faster than the liabilities which are due. So that's reason one. Reason two is the leverage of the entity is pretty low. So entity is sitting on a lot of cash, because of which again the ALM risk is pretty low. In terms of names for the entity, the names are roughly between 8 to 10%.
Honest.
So the onward lending rate for gold loans is between 20 to 22%, and the cost of funding for Dhanvarsha broadly is between 11 to 13%.
Yep. Thanks. Uh, can you provide any circular which shows the change in credit rating agency models?
So these are their internal models only, so they don't make it public. When we structure any transaction, we engage with the rating agencies, and their views are also evolving because these are new products in the market. So their models are also getting stabilized. For these transactions, if we give up the right to take entity to court, uh, if they don't make the payment after 15 months, we can still get a higher rating. But we don't want to give up that right. We want for a covered bond to have actual dual recourse. I should be able to take NBFC to court if NBFC misses the repayment, and in parallel, I should have the right over the second level of security. I, as an investor, don't want to give either of these two rights. So hence, we are fine taking a lower rating, which is only optics. It is not adding or reducing any real value. These are only optics. What we need to care about is the risk in the transaction. So we are fine with a lower rating, but we want to reduce risk for our investors.
How to apply? You can get in touch with our education team, and they will guide through transaction either on the exchange through your broker or through Iccl, right? Most of the brokers you can directly buy it, or you can call your, in case of some old brokers, especially NSDL brokers, these securities may not be able to directly, you can put a buy order yourself. Then you have to call your relationship manager at the broker's end, and the broker, they will put the order from back end, right? But in general, if you are not directly putting the order, if you are talking to a relationship manager, I would strongly recommend to get our team member from education team involved, and they will make sure that transaction happens smoothly and without any trouble. Yeah. Yes. uh, how much TDS will be deducted for the interest earned, and what would be the return on investment plus interest? So there will not be any TDS deducted, since these are listed on exchange, and in all NCDs that are listed on exchange don't have any TDS. The return on investment will be 11% XRR basis, right? In addition to the principal. So the interest, you can exactly check the amount on the website, and Pranav can also put it in the question, in the answer. Will this be a diversification portfolio who has 25 lakh in total value? Definitely not. If your total portfolio is 25 lakh, this is not a right investment for you, since this investment ticket size is higher. For smaller ticket size, it might still make sense, but not for a 25 lakh rupee total portfolio. Is there any way for NRIs to invest in these bonds? NRIs cannot invest in these bonds, right? How many NRIs invest? Either they invest through their parents or some close relatives in India, or through their HF account. But both carry their own risk, right? So take your judgment. But as a NRI, you should not and you cannot invest in these accounts. Many NRIs, we have seen that they, even after knowing this, they tend to invest. Uh, like, and we strongly recommend against it, because if some regulatory change regulation, some regulator or some authority catches hold of it, it might invite trouble for you, right? So if you're NRI, don't invest in these bonds. If Wint is closed, what will be the mode of payment? uh, as these bonds are listed on stock exchange, Wint is a just platform to invest and get access to those bonds. These bonds are independent of Wint. So even if Wint shuts down, it doesn't change anything. At the end of maturity, you'll receive the payment in your bank account that is connected with your Demat account. Yes. Wint wallet. Okay. If you meant key, if Wint wallet is closed, what will be the mode of payment? Okay. Okay. I probably misunderstood this question. My apologies. So either you can buy it through exchange or through Iccl. I've spoken about it before, right? Through your broker, you can simply put a buy order, like how you buy any equity share, right? Any stock, you will be able to buy or sell order, right? And Wint wallet has been discontinued, right? So you cannot add money to Wint wallet anymore. Yes. Okay, Atul, hope this answers your question. If it doesn't, please ping us here or get in touch with any of our education team members. Security. Okay, moving on to the next question. Security cover is 1.25 times the loan value on the first level. Those loans would have been also given at a LTV of around 70%. So that collateral value will be higher, right? What are the collateral values of each gold and property at second level?
All right. So the average LTV for gold loans is between 70 to 75%. For property loans, it's much lower. I think the details are there in the rating rationale and also on the website.
Thanks, Anshul. Are SPV trustee one and the same?
So SPV, it's like a legal entity, and trustee is the person responsible for managing that legal entity. So trustee is just taking care of the operations, compliance, and money flow for the transaction. They are more like a service provider. And SPV is a legal entity setup to segregate the underlying collateral pool to make it a bankruptcy remote with respect to the NBFC.
Thanks. The next question, why is investment threshold kept at 10 lakhs and not a lower as in other investment, especially with all digital transaction and platforms? We understand this sentiment. This is because of the regulatory change that recently came in. We are we are working in the change regulation scenario, and it is actually boosting what we are doing. Shortly, we will be back with where the investment threshold will be much less than 10 lakh. It will be in the range of 10,000. Can charitable trust invest in covered bond? Yes, they can. Uh, does section 11.1 whether that is applicable? We have to check this and get back. I would request before investing, if you are a charitable trust, please get in touch with our education team. So they will guide us through, and they will also check, make sure that if there are any other compliance issue or any other thing, then we will get that sorted. What happens when asset value starts dropping like 2008? The collateral value also drops. How does 1.25x helps? The risk remains irrespective of the collateral.
All right. So like I mentioned, these are, at least for gold loans, these are demand loans. In case, let's say overnight, there is a 15% drop in prices of gold, NBFC will ask borrowers to either pledge additional gold or prepay their loan to a certain extent so that LTV again comes back to 75%. In case, let's say some borrower does neither of the two things, NBFC has full rights to liquidate the gold and close the loan. In a hypothetical scenario that overnight 50% fall in gold loan prices takes place, yes, then I think the capital can be at risk, because even if NBFC sells the underlying gold, the recovery would be lower than the outstanding value of the underlying loan. In such black swan events or such extreme events where overnight gold prices fall by 40, 50, 60%, there might be a shortfall at a collateral level. So which means if NBFC has defaulted, then yes, in your repayment there might be some shortfall.
Understood. Uh, Minimum investment is 10 lakh, but the unit price is already more than 10 lakh. Why is it so?
Right. So if you look at the bond, it has been issued at 12% interest rate, while we are selling it down at 11%. The difference 1% is the margin that we are earning as a platform. So some difference will be because of that. Secondly, on a daily basis, you will see the buy price will increase by a certain amount. It is happening because the tenor of the bond is fixed, which is 15 months. And at the end of 15 months, how much entity will repay, that figure is also fixed. Now imagine there are two investors, one who is investing today and second who is investing 30 days down the line. Both investors will receive the same amount since the repayment from the NBFC is fixed. While first investor invested for a time period which is 1 month longer than the second investor, hence, which is not fair. Hence, the purchase price of investors is adjusted in such a way that both earn 11% XIRR returns. And because of this, on a daily basis, price increases by a certain extent.
Understood. NBFC has very low cash flow in past 4 quarters. How do you cover that risk?
Uh, I'll need to understand what do you mean by cash flows. Maybe if you can elaborate on that, or we can take it offline also. If your question is with respect to profitability, then entity has been in a expansion stage. They are opening a lot of branches, etc. Hence, the operational expense of the entity is on the higher side. So you would see the credit cost or the losses in the portfolio are still very low compared to industry. But the operational expense in terms of opening new branches, paying salaries, rents, etc., is on the higher side because entity is in expansion mode, because of which profitability is slightly suppressed.
Got it. Okay. Ajinkya, you mentioned initially that you purposefully degraded the bond rating for increased coupon rate. But Anshul mentioned some change in models of credit rating agencies. So I want to clarify, we didn't purposefully degrade it. We kept the structure same. If we had to go for enhanced rating, we had to weaken the structure. We just avoided that, right? It is actually nothing to do with coupon rate or change in coupon rate. It just whether it is a trade-off between getting a higher rating and making a structure stronger. We chose to keep the structure stronger and not weaken it. Right. So that's the only thing that we have done. It has nothing to do with coupon rate. What would be the increased interest rate if there is a default post 15 months, payment back to investor gets delayed? It definitely covers the 11% interest rate, right? But is there any
And
additional interest that happens?
is if NBFC has defaulted, there is a step up of 2 to 3%.
Understood. Do you at Wint access this pool of gold collateral, or do you depend completely on NBFC for it?
Sorry, kindly repeat.
So do we do the cross checking of gold collateral, or do we completely depend on NBFCs, or do
Right.
you
So,
do
like
random?
I mentioned, on a sample basis, we keep on doing audits, and these audits happen on a almost on a quarterly basis. So yeah, we do go in to the branches of NBFCs and audit whether the gold collateral is actually there or not. The weight of the gold collateral is matching with the weight that was shared with us, and so on.
Understood. Yes. Can I use IDFC payment first bank gateway to pay for this? Last time I did not see IDFC bank at payment gateway. How can I use Zerodha for subscription? So henceforth, there is no payment that is happening through payment gateway. So you can use your Zerodha account. You can simply go and put a buy order for this security. How to put buy order? What is going to be the script code? If you have any doubts regarding it, please get in touch with our education team, and they will make sure that this transaction happens very smoothly. And if there are any troubles, they can assist you. Uh, okay. So I'm just covering questions specifically related to this asset. There are other generic questions around, like there is this one question: what is the relationship between investor, Wint Wealth, and SPV? We will cover those questions at the end, which are very structure level questions, right? What's the so I'll move to the next question first. We will finish the especially asset related and NBFC related question first, and then we will get into asset related questions, right? If you want to specifically, if you're a first time investor on Wint Wealth, right, and if you haven't gone through previous asset or considered investing in previous asset, we have done one webinar specifically on how to invest with Wint Wealth basics, right? So we have gone through structures, how do we select NBFCs, how do we do due diligence, what is the procedure like, how do you, how do we monthly update the report, what are the interest rate looks like, how, and the whole journey, and what happens at the end, what happens when the bankruptcy happens. We have covered all those questions in that webinar, right? So if you're investing for the first time, I would request everyone, if you're first time investor, please go through that webinar. That will answer all your questions comprehensively. Post which, if you have still any questions, please get in touch with our education team. We get on phone calls. We, if required, we also get on Zoom calls. Some of the times, founders also come on Zoom calls to educate the investors and discuss the risk, asset structure, etc. Right. One thing I always advise people is don't invest unless you understand the asset class, the structure, and the mainly the risk involved. Right. We'll cover those questions also at the end. So moving on to the next question, what is the gross interest earned on the underlying? Anshul?
Yeah, for gold loans, it's between 20 to 22%, and for LAP, it's slightly lower. I noticed one more question asking whether such high interest rates mean that end customers are like very risky, etc. So we need to like understand for gold loans, yeah, if you leave aside banks, most of the NBFCs, be it even someone like Muthoot, Manappuram, etc., the on lending rate is between 16 to 24%. It might look higher, but if we like analyze it further, it's also higher because a lot of geographies that these NBFCs are serving, there are tier 2, tier 3 geographies, which means the branch portfolio will be, let's say, between 3 CR to 15 CR. Implication of this is the operational cost of generating that 3 crore or 5 crore worth of portfolio is significant. So out of this 20% that NBFC is charging, between 5 to 8% goes in servicing only, in taking care of the operational expenses of the portfolio, in terms of paying rent for the branch, paying the employees, doing collection, origination, marketing, etc. Hence, the industry needs to operate at these interest rate levels to make it economically viable for NBFCs. So for gold loans, if you see, the on lending rate is between 16 to 24% across most of these NBFCs.
Yeah, sure. Yeah, you also answered the next question. Does that mean these are high risk borrower? Right. So you clarified that. Okay, the next question is from Pawan. What if the gold value dips by 20-30%? Whether the collateral or pool value gets reduced, exposing the risk to the investor. How pool value will be adjusted?
All right, I think we already answered this. These are gold loans are demand loans. Entity will either ask borrower to pledge additional gold collateral or ask them to prepay the loan to a certain extent so that LTV again becomes 75%. If borrower doesn't do either of these two things, NBFC has full right to liquidate the gold collateral and close the loan.
Understood. In case of default, who will liquidate the pool and give investors the money? Who are the trustees? What is their incentive to liquidate and distribute money to the investors?
Right. I think the question is in the scenario that even NBFC has defaulted and there are defaults happening in the underlying pool. So trustee is acting on behalf of the investors. Trustee legal has full legal rights to appoint a alternate servicer, and that alternate servicer will step in and start doing the servicing in the scenario that NBFC has defaulted and has even stopped its operations. So that servicer and trustee will run the show from in that scenario. Trustee in our transaction is Catalyst Trusteeship Limited. In Indian debt market, they are amongst top two trustees to work with.
And more than that, Wintwealth will be always involved because our credibility is on the line, right? Because our brand is on the line. So for that process to happen smoothly, we will always be involved and we'll take care. And therefore, we generally invest 2% in every issue, right? So we are generally the largest largest investor for every issue. As a company, in every issue we hold 2%, right? And I don't think we allow anyone to invest more than 2% in any of the asset, right? So we are always the largest investor of the every issue, right? So that should give a comfort, so that when things go wrong we are also involved, right? Yes, please post a transcript and video of today's session on your website after you are recorded. We will definitely do, that's the plan. In fact, what we'll do is we'll cover every question so that people can just click on a question and find out the answer. The interest rate on gold loans is significantly high, and this cause of alarm for Wintwealth toward bad loans. Anshul, we already answered this. You want to again answer this very shortly?
Like I mentioned, if you look at the gold industry and mostly gold loan NBFCs, the on lending rate is between 16 to 24%. It doesn't mean like the end borrowers are riskier. It's mainly high to cover the operational expenses in running these gold loan branches. Out of this 20%, let's say, which entity is charging, between 5 to 8% will go in the operational expenses part only, because the branches are located in tier 2, tier 3 geographies, and the portfolio size per branch is also between 3 cr to 15 cr, which is not like very high, uh, so that operational expenses will spread over a large base. Hence, OPEX in this industry is definitely higher, and to make it economically viable, these NBFCs end up charging 16 to 24% rates to their end borrowers.
Uh, Thanks. So the property pool seems concentrated to one state, that is Maharashtra. Who chooses the loan, and if it is Wintwealth, why wasn't it diversified?
Yeah, property loans in case of Dhanvarsha, it's a central branch catering to regions around Bombay only. So we have done diligence on the end borrowers. If you look at the criteria for selecting these borrowers, it is much more stringent. The seasoning requirements, etc., are there, and the LTVs are also much lower. And since from a from a pool availability point of view, since Dhanvarsha in property loans is working on a centralized model basis, their end borrowers are concentrated in Maharashtra. So to mitigate this risk, we have done a much more deep diligence on the end borrowers.
Sure. The next question is, I have referral. How do we make benefit of this investment? So we had launched a referral program, but in the light of change regulation, we have withdrawn that referral program. However, we really appreciate you getting us the referral, and in more than referral, you going out and talking about us and educating the investor. Therefore, we'll roll out the referral program again. And before, whenever your referral actually makes the investment, please let us know, so that whenever we roll out the next referral program, we'll make sure that you are we give that referral program benefits to you as a token of appreciation. What are the trigger events for liquidation of covered pool?
So there are various trigger events, including factors like portfolio performance of the entity, the rating of the entity and the instrument, the NPA numbers in the portfolio, breach of covenants, etc. These events are mentioned in the rating rationale, which is there on the website. So quite a detailed list. I think it's there on the website.
Understood. As I understand, if I wait till maturity, then there is no need to do anything, like selling on stock exchange. Uh, the payout will be credited back to my account. Is this correct?
Yes, there is no action required at investors' end. on the due date, entity will make the payment to the trustee. Trustee in turn will deposit money directly in the bank account linked to your demat account.
Understood. Anshul, but could you clarify about that tax arbitrage that is dependent? Like there are two views in the market, right? Whether you hold till maturity or you sell before maturity.
Right. So in case of MLDs, like we discussed, the taxation rate will be 10% since the underlying is linked to a reference index. There is an alternate and a more conservative view, which few market participants are taking, which says like you need to sell the MLD before maturity, can be 1 week, 2 weeks before the maturity, to claim that 10% taxation benefit. If you talk to big four consultants, a lot of them will say even if you hold till maturity, you should be able to get a 10% benefit. Having said that, if any of the investor wants to take the conservative view and they want to sell the MLD before maturity, they can contact us, our customer team, using the number available in the website, and we can facilitate that exit or that sale 1 to 2 weeks before the maturity date.
Thanks, Anshul. Okay. There is one question: UPPCL versus this bond. Which one carries lower risk?
We'll need to look at the bond. Not very sure about the details of the bond.
I think this is, I mean, obviously we can't comment, but I guess this bond is of UP Power Corporation Limited. Okay.
See, in general, I want to like tell our investors one thing. A lot of us think that since a lot of these power sector bonds are issued by government entities, these are risk-free bonds. That is definitely not the case. We have seen instances of default in these power finance companies. AP Power Finance company had issued a bond some time back, and that bond did see repayment issues. So don't just assume since these are government-backed institutions which are issuing the bond, these are risk-free. Government is not giving a guarantee on most of these bonds which are floating in the market and are offering returns around 10%. So be very, do your diligence before investing in such bonds.
Great. Yes. Why do you say that money coming from gold loans in a year would be helping bondholders? The money would go to Dhanvarsha itself, correct? Right. So probably I'll answer this very shortly. Even if the money comes to Dhanvarsha, they have to give us another new loan to make sure that outstanding loan pool is 1.25x of the year. Money coming back to Loanvarsha is good because the repayments are happening. The portfolio is in general good, right? So that's the answer. Uh, who has the first right on liquidation? Aren't there more or bigger lenders?
No, these loans belong exclusively to our transaction. No other lender can have a claim on money or repayments coming from these loans which are there in our transaction. So covered bond investors have a first right, exclusive right over these loans.
Understood. When the investor gets 11%, it means SPV gets more than 11%, say 12%. Now the entity charges more than 12%, say 13%. Generally, home loans today are 9%. Loans at 13% means lower quality asset or poorer, lower value person taking a loan. Am I right?
But if we look at the LAP loans which are being given, uh, so there is a large customer segment in India which banks are not catering to. For example, if you look at any kirana shop owner, that person, he might have a turnover running in a couple of crores, but he might not be doing his tax filing, and all the statements etc. may not be in place. So that kind of borrower, typically a bank will not cater to. Doesn't mean the credit profile is significantly weaker than, let's say, a customer that bank is catering to. So this segment of economy is what most of the NBFCs are targeting, which have traditionally been excluded by banks. Within this segment, yes, there will be borrowers which are prime, and there will be some which will be slightly riskier. So, and different NBFCs are targeting different layers within this segment. And since NBFCs don't have the liability advantage that banks have, banks are able to raise capital at 4 to 6%. NBFCs are raising capital between 8 to 12%. The on lending rate tends to be higher. And also the operational expense in terms of catering to this segment of society is higher, which in turn translates to a much higher cost of lending for these borrowers.
In case of default and the gold prices also drop drastically, which may not cover the loan amount, what happens and how is this situation will be taken care of?
Ajinkya, can you repeat once?
So basically, when default has happened, even the prices have gold loan falling down, and if the LTV is gone more than 100, or does that happen? How does that happen? And how does this situation is taken care?
All right. So in a scenario that NBFC has defaulted, and let's say overnight gold prices have crashed by 50%, even after liquidating the gold collateral, there might be a shortfall in your repayment. So that is the residual risk that you as a covered bond investor are bearing. And you need to like take a call, like what's the probability of such a scenario taking place. There is adequate cushion for let's say fall in gold prices of 20%, 30%. There is a over collateralization of 25%, which means even if 25% of the borrowers don't pay even a single rupee, still collateral is adequate to repay the bondholders. But in an extreme event, a black swan event, wherein there are 50% losses in the underlying collateral pool, in that scenario, yes, there will be a shortfall.
Understood. Yeah. In case of delay of payment of fund, will we continue to gain returns for the period of delay? Yes. Uh, uh, what are the steps mentioned to transfer money to ICCL? Since this will be happening for the first time on the platform, if you're doing transaction through ICCL, many of you will be probably doing first time transaction through ICCL itself. So I suggest rather than me answering the question here, please get in touch with our education team. One of the member will closely help you to make sure the transaction happens smoothly. Otherwise, it will get the experience will get very bitter for you, and we don't want that to happen. So please feel free to get in touch with our education team. Mm, is this fixed return of 11%? What is the market link for this?
Yeah, the returns are fixed at 11%, but like I discussed in the presentation also, these are market linked debentures. And how the linkage is done is if the Sensex value at the end of 15 months is above 11,300, which today is more than 50,000, till that point of time, you will earn 11%. In the scenario Sensex has fallen by more than 75-80%, then there won't be any interest payment. Then the entity will only repay back the principal. The probability of such an event happening is quite low because we haven't seen Sensex dropping 70-80% within a time frame of 15 months. But yes, a theoretical scenario still exists.
Is there any other bond structure that Wint is planning to launch in future, such as semi-annual coupon payments, longer duration maturity, collateral pool beyond gold or property loans?
Yes, we are working on number of structures. So we are also working on monthly interest repaying bonds. Then there are bonds wherein principal itself will be released with it before the maturity. For example, in all the transactions that we have brought till date, principal has been repaid at the end of the transaction. We are working on certain bond structures wherein there will be 3 tranches of principal repayment, which means if the bond size is 30 CR and the tenor is 3 years, then 10 CR will be repaid at the end of year 1, 10 CR at the end of year 2, and balance 10 CR at the end of 3 years. Even in terms of underlying asset classes, there is a lot of work happening there. And we are looking to expand beyond gold, vehicle, and property loans.
Sure. Uh, Great. The next question is, will this asset be available in ICICI Direct? Can you name a few brokers where it will be available? Uh, I'm not sure with whether it will be available. I guess it would be available in ICICI Direct. If you're directly able to place order yourself, then you need to probably get in touch with a relationship manager at ICICI Direct, and they would help you place the order. Many of these securities, especially debt securities, are not available on the interface or the front end of the broker, right? But they are generally placed by backend team of the broker, like the relationship manager of the broker. Uh, yes, who are the other players in covered bond market? Is Wintwealth only player in this field? There are many players in covered bond market, but for individual investors and focusing only on individual investors, Wintwealth is the only player. Other players majorly focus on uh, placing these instruments for banks or other NBFCs or other institutional investors, including foreign investors. Wintwealth is the only platform that is currently focusing this for like individual investors, right? Uh, for the previous Dhanvarsha asset, each loan must be the criteria was each loan must be originated by the company and must be a gold loan. This was a pool selection criteria. Is this criteria removed for this issue? I understand that many of the loans in this pool are originated by partners of Dhanvarsha. Is that the case, Anshul?
Yes, so the sourcing is done by different partner channels, and that's the case with most of the NBFCs. Different NBFCs tie up with each other and help in sourcing each other. But underwriting of the customer, which means evaluating the case, seeing whether it's eligible or not, is still done by Dhanvarsha, and that's the case for this transaction also. Few loans are sourced by partner NBFCs. Dhanvarsha is tying up with different partner NBFCs, which are sourcing cases for Dhanvarsha. And Dhanvarsha is underwriting those cases and working on a partnership model with them. So origination, by which we mean the underwriting of the cases, is still done by Dhanvarsha.
Yeah. So all the loans are 100% originated by Dhanvarsha, right?
Yes, 100% underwritten by Dhanvarsha. It can be sourced by various channels.
Yes. If the maturity date is extended by 30 months, considering delay, how much will be the maturity value interest rate at the customer will get of end of 30 months? It will be still 11% XRR, but if the NBFC has defaulted, it will be little more, Anshul. How
Yes, it
much
will
will it be
increase
more?
by almost 300 basis point, 3%. It will increase by 3%.
Okay. The same question is next. There is some IAM document. There is this IAM document says following: notwithstanding with any other provision of DTD and the other transaction documents, it is hereby certified that where the event of default other than payment default occurs, the issuer shall pay interest of debentures at 15% per annum on outstanding principal basis. From the date of occurrence of such event, default until such event of default is cured or secured obligations are repaid. Why doesn't payment default trigger credit event and higher step up rate?
Yes, even payment default triggers a step up of interest rate, Omkar. It is captured at a separate place within the IAM.
Will Wintwell share updates on regular basis on performance of NBFC with investors? Please share some details on it.
Yes, so on a monthly basis, once you invest on in any of our assets, you get a dashboard on your on the website, and within the dashboard, within each asset section, there will be monthly updates which will be shared both on the underlying NBFC and on the underlying pool also. Like I discussed, the pool will be a slightly dynamic pool. There will be replenishments happening on the underlying pool. So what kind of loans were added for the previous month? What's the current status of the pool? All those details will be mentioned in the dashboard.
And that report will come on monthly basis, right?
Yes.
Honest. Uh, do you plan to launch MLDs with different tranches, such as interest only, principal only tranches to seat investors of different risk appetite?
No, as of now, we are not targeting any interest only or principal only tranche. Most of the MLDs will have both interest and principal component.
Understood. On page 76 of IM document, I see following: step up, step down coupon rent is not applicable. In your earlier asset, this wasn't the case. Can you clarify this?
Uh, the drafting is different, Omkar, slightly. I think you're referring to the payment default step up clause. We'll point it out to you in the IM where this has been captured.
Okay, thanks. Have you audited any branches of partner NBFCs of Dhanvarsha?
Not in our initial audit, but in our quarterly audit, which in fact is scheduled for early October, we will be covering branches of these partner channels also.
Understood. But we have already visited some of the NBFC branches, right, of Dhanvarsha at different stages.
Dhanvarsha's branches we have covered.
Understood. Okay, partner NBFC branches we haven't visited, but we plan to visit. Understood. Yes. Do we subscribe to these bonds UPI payment, or no? You cannot pay this for through UPI or any other payment gateway. There are only two ways of doing this. One is placing order through your broker account, let's say Zerodha or Upstocks or Grow or whatever, or through ICCL. For making the transaction through ICCL, please get in touch with our education team. Okay, here is the next question. In line with the above question, can we rely on the audit done by our team? Basic concern is that audit is not done just for the documentation purpose, but to represent the correct picture. I completely agree with this question, and I get what you're coming, where you are coming from, Mr. Kushore. The thing is that, therefore, we have skin in the game, right? If like we are the largest investor in this deal, and generally the every deal, right? We invest 2% of the money in the in every asset, right? Therefore, our money is also on the stake, and if things go wrong, we are also punished, right? Therefore, we wouldn't do this documentation just for the sake of doing the documentation, right? We have our strict protocols. We do regular visits, right? And you can trust us on that. uh, the risk is obviously doesn't make it zero, but you can trust that because we have skin in the game, right? Finally, words like actions speak louder than words. We have put in our money behind this, right? So that should give you the comfort, but ultimately you have to take call on the basis the facts that you have in front of you. How to ensure that NBFC doesn't give a covered pool asset to any other party as collateral?
Uh, Azim, can you repeat once?
So like double, like how do we ensure that NBFC doesn't give the same covered pool to some any other lender as collateral?
Right. So when we do our quarterly audits, all these loans which NBFC has, they get tagged to different lenders. Let's say Dhanvarsha has 10 lenders on their balance sheet and have, let's say, given out loans to 1 lakh customers. So each loan will be tagged to a particular lender. And in our audit, we cover that our loans are tagged only to us. And this is visible in their ERP system also. So our audit covers this risk that same loan doesn't get tagged to multiple lenders. Ideally, I think a structural solution to this will be if maybe some regulator can create a central database, so which is visible to all the lenders, everyone in the market. I think it's more like a structural solution to this problem, so that lenders don't have to continuously go and do this audit. And SEBI recently has taken such an initiative, wherein they are asking, at least for bonds, they are trying to create a central database that each loan which NBFC has given is tagged to which lender. That's a database which they are creating for bonds. Ideally, across lenders, there should be such a central database. Till such a database comes to life, lenders need to do their own audit and see in the ERP database whether this collateral is given only to that lender or not.
Thanks, Anshul. You mentioned MLTs are linked with Sensex. Does that get reset at certain frequency? I mean, does that 11K number change during the tenure of MLD?
No, that number remains the same. and it needs to be checked at the end of 15 months when the payment is due. What's the census level on that date? Doesn't matter census has gone up or down during the life of the bond. At the end of 15 months, what's the level of Sensex? If it's above 11,300 levels, the 12%, 11% interest will be paid to the investors. If it's below, then only the principal will be returned.
Uh, yes. Do, uh, do does credit risk fund offer covered bonds? I thought at most they offer secured bonds which have higher risk than covered bonds.
Also, like a bulk of their exposure, more than 90%, 95%, is still in secured bonds. In one of case, we have seen a couple of fund houses take exposure to covered bonds.
Sure. What is the percentage of risk in of your platform for our investment? I didn't get this question, Sureshji. If you could elaborate on that, that would be helpful. But for every issue, we generally we are the largest investor in the issue. We invest about 2% of the issue size and we hold till maturity rate. So that's how we have skin in the game. Uh, why the credit rating is triple B? Don't you see the rating is risky? What was there any downgrade in last 1 year?
There was no downgrade. In fact, Dhanbasha has been upgraded from triple B minus to triple B because of the equity raise and increase in their size, etc. Uh, in terms of rating, triple B rating being risky, I think to a certain extent, uh, we need to look at the point at which we are taking exposure in the entity. If we analyze the entity has a pretty low leverage and the tenor of our facility is only 15 months. When a rating agency is assigning rating to an entity, they don't assign rating for only 12 months or 24 months. They want to see stability in their rating also. Obviously, over next three years or 4 years, the leverage of entity will increase substantially. So rating agency won't assign a category rating today because leverage is low, and then downgrade it to triple B rating once leverage crosses 3 years, because they want to have stability in the ratings that they are assigning. So rating is like very contextual. If we look at to if we had to analyze the entity irrespective of the rating, we are giving a 15-month money to an entity which has pretty low leverage and is backed by gold loans collateral, which I think is a risk worth taking, irrespective of what the ratings are saying.
Yeah. Thank you for the explanation of on ALM. It would be probably even better if you include unused lines of credit. And I'm happy to hear about the NIMS of 8-9%, which is very healthy by any standard. Though higher NIMS could indicate a tad higher risk.
Yeah. So Arnav sir, I think if we look at the unused credit lines, entity has lines of at least 50 CR from various lenders. Your point is valid on 8 to 9% NIM. It is higher, but like I said, roughly 5 to 6% of this will be consumed by OPEX. Balance 3% will be their ROAs, etc., out of which some percentage will be consumed by credit cost, and balance will be their profitability. And these names are high in this sector, like I discussed, because OPEX is also high, and OPEX needs to come from these names only.
Is there any plan to work with stockbrokers like Zerodha to include your products in their collateral list? Currently, they are not allowing. So it is not the broker that has authority to decide which securities to include or which is not. It is with the regulator. We are talking to we will be talking to regulator, but we don't see this happening very fast. Especially the pledging of asset of these direct bonds. Even like high rated bonds, AAA rated bonds are not like and issued by private players are currently not allowed for pledging. So the regulator doesn't seem to be comfortable. So we don't see that happening soon. Whenever it happens, we will keep you posted. Right? When will we have option to invest less than 10 lakh? We are coming up with public issues, and once the public issues start coming, you will invest. You can invest 10,000 rupees and start from there. I couldn't find the Wint Wealth on BSC website. Please clarify. Uh, as as we have spoken about this, right? Wint Wealth is a platform, right? The security that is listed on the stock exchange is issued by the partner NBFC, and those securities can be seen on BSC. You can purchase through your broker, right? And we can mention the script code. Our script code is mentioned in the detail. Pranav, in the answer, if in the comments or in the answer to this question, if you can mention the script code, that will be easy for Shankar to find out this. But Wintwealth is not listed, or non. The bond is not listed by Wintwealth. Wintwealth is a platform. The bond is issued by NBFC. We are helping the structure. We are helping to structure these bonds, to educate investor and help investor buy these bonds. Right. NBFC has very low cash flow. How do you feel it is safe with NBFC cash flow?
I think we answered this question, Ajinkya.
Okay. Cool. How do you track investments on dashboard if transaction happens via exchange? Currently, we are adding this manually. We are integrating both so that if you have transacted on exchange, then it will start reflecting in your dashboard automatically. But currently, this is happening manually. Another risk is index falling below 11K. Yes, there is this risk, but this index is Sensex and not Nifty. Often people here, they think that this is Nifty. We are talking about Sensex. Sensex is currently at 56,000 or 57,000. So the risk that it will fall 80% is there, but it's like how realistic it is. It needs to be seen. I don't think it is that realistic. Obviously, it is non-zero, but nobody is able to predict the market, right? So you'll have to take that call on by yourself. When does Wind get its 1% from 12% coupon? We get it when you make the investment, right? There is one more question: how much we make? We make about 1.5%. And some of the it comes from the NBFC, and some of the it come from by selling the bond at a higher price. We make about 1.5% per year, right? And that we get that money when you make that investment at the start. If there is a default and payments to the investor get delayed, what would be the increased interest rate paid to investor? Anshul, how much will it be? 15%, is it right?
Yes, it will increase by 3% approximately.
Okay, 3%. If there is a default, and okay, we have already answered this, but if there is a default and gold prices also drastically drops, which no longer covers the loans given, then what happens?
Yes, that's the risk that investors are carrying. That's the residual risk in the transaction. That even though we have a 25% extra cushion in terms of extra security cover, and each loan has a 25% margin built in. But let's say tomorrow, if overnight gold prices were to fall by 50, 60, 70%, and entity has also defaulted, there will be a shortfall in repayments to the investors.
Yes, just mm, yeah. Percentage of split and gold property loans component of the loans for gold bricks. I guess we have already answered this. 75% are gold loans and 25% are property loans. Residential status of NRI is evaluated during the purchase or during maturity. I guess it is at the time of during the purchase. So if you are already NRI, you wouldn't be able to buy. Uh, Once I buy through Zerodha and procure this covered bond, can I pledge it on Zerodha and get margin benefit? No, these bonds cannot be pledged for margin benefit. Do you have branches in any other parts of India? Where is your head office? Our head office is in JP Nagar. We sit out of Zerodha's office. We don't have any other branches. We don't plan to open this completely digital platform that we are trying to build. So our head office is in JP Nagar. We don't have any branch, and we will probably not have any branch. Uh, Yeah, Wint's revenue is on trail basis or issuance basis. What is the skin in the game? So our revenue is the issuance basis. We make revenue at the start. What is skin in the game? We always keep 2%. We always buy 2% of the asset, and we hold till maturity, right? So that is our skin in the game. Where is IM document available? Pranav, can you share the link in the question? Yeah, okay. It is already shared in the comments, right? And same will be uploaded with rating rational on the website soon. Script code, okay, Pranav has shared the script code in comments. It is DFL 020921. I see some transaction that happened today for DA for the same security. What are these transactions if product will be launched tomorrow? Onkar, that's a valid question because the transaction was listed. We are making some transaction to test out whether there are any problems, if it is all working. So we generally do that one day before, right? So for every transaction, we will find this one day before we open the transaction. We do this transaction with uh, internal users and internal users and select users. Uh, Yes. So why referral program keeps on changing live and offline? So we only launch it once. We have taken it back because the regulation changed and because there are no transaction happening through payment gateway. Tracking was very difficult and that created a lot of confusion and bad customer experience. However, we plan to bring it back. In the meantime, if you actually refer someone, please let us know. So when the next referral program goes live, we'll share the benefits as a token of appreciation. Right. So yes. Uh, then there are so these covers the mainly asset related questions. I have an Zerodha account. Can you advise how to buy from it? You can simply put the script code and buy order. But if you're transacting for the first time, please get in touch with our education team through our WhatsApp number on the website, and they will help you through the transaction. Right. So it is like buying and selling equity on Zerodha. That there is nothing really different here. Yes, I'm just looking at. Yeah, what would be the basis of allotment in public issues? This will help me decision whether to go for private issues, higher concentration risk, or public issues, lesser risk as risk gets diversified across multiple assets. If basis of allotment is lottery, then no point in waiting for public issues. Uh, Onkar, this is a very valid question. We are working on it. We actually want to make it available for existing investor first, and we are taking step towards it. But we will get the clarity once we execute the public issue. As far as if you ask stand of Wint Wealth, we clearly want it for our existing investor first because we have been telling them to diversify, and that's the right way of investing in this. But whether it is going to be lottery or we get to define it, we'll able to conclusively tell you after the first issue. As far as things are going, what I can definitely tell you is we are seeing that we will be able to create give a preferential access to our existing investors so that they are able to diversify. Mhm. Yes. uh, are you thinking of making are you thinking of are you going to launch lease financing too? Anshul, do you want to answer this?
Not in a like immediate future, maybe sometime down the line, we might want to do lease financing. But the kind of entities we'll be working with, they'll be mostly larger entities uh, and may not be startups, etc.
Understood. Where can when can we expect public issue? It will come in October, month of October, and once it start coming, once the first couple of issue timelines might get here and there, to be frank, because this is happening for the first time. Once couple of issues happen, there will be many more issues coming. In general, we want to reach 4 issues a month kind of frequency very fast. I have referred to my friend via WhatsApp screenshot. Tomorrow he is investing. What kind of proof do you need? His Demat account or my WhatsApp screenshot? We don't need much, Pawan. We just let the person who is investing to WhatsApp us saying ki I got referred by Pawan, and that should do it. I mean, this we treat our investors very personally, so we don't need any procedures or etc. We just need a confirmation from your referral that he invested through your reference, right? Yes. I guess we have answered all the questions.
There is one question, like why will a NBFC
Okay.
raise capital from Wint Wealth and not from a bank?
Yeah. You want to answer that, Anshul?
Yeah, so I think there are multiple benefits that a entity gets. One is any NBFC will want to diversify its liabilities. Like if I am a NBFC, I'll want maybe some capital to come from banks, some from foreign investors, some from mutual funds, and some from retail investors. Before Wint Wealth, this retail channel wasn't available to these NBFCs. Now with Wint Wealth's investors stepping in the market, this base of retail pool of capital is also getting unlocked. So NBFCs are more than willing to in fact pay a premium in our transactions to tap our retail investors to get access to retail capital. Second benefit is via Went Wealth, they are also building a brand amongst our retail investors. So that is another intangible benefit that entities are getting. So these are some of the motivations because of which even NBFCs are very keen to work with the Went Wealth platform.
How often do you interact with Mr. Kamath being in same office? We actually don't sit out of same office. Zerodha has two offices where we're very nearby. All the all the rain matter companies or all the startups that are funded by Wintwell, all the companies organizations that are funded by Zerodha sit out of the another office. We don't sit out of the Zerodha's main corporate office. It is pretty nearby, about 100 200 meters. Right? Yes. Will you be placing sell limit orders at 9:15 a.m. tomorrow on exchange or some other time? Uh, Indrajit, Pranav, what is the live time for this deal? Are we going live tomorrow at 9:15 or could you clear in comments? Okay, there is one comment from, okay, 9:15 only. Yes, so we will be putting sell orders. Generally, we want to track who is buying so that we educate about the risk since these are high ticket size investment. So we generally help one by one saying, so if you are planning to buy for this issue, if you are anyway planning, please get in touch with our education team. So we will get in touch and help you transact, right? Karan says thanks a ton, very informative. Thanks everyone. It did go a lot longer than we expected. All right, and very quality. The quality of questions was fantastic today. We really enjoyed answering the question because we do a lot of homework, background work to make the asset watertight, structuring etc. And when such pointed question get asked, it is often pleasure to answer those. What will be the unit price in public issue? Public issue, it will be 10,000. Uh, yes. Okay. Are you thinking? Yes. Any question, Anshul, that is remaining?
No, I think we have covered all the questions.
Great. I hope you guys have enjoyed this session and it was a session that taught you something about covered bonds. If your questions are still answered or in general you want to know more, uh, please feel free to reach out to our education team. We are more than happy to educate about the structure and the risk involved. Right? It is one of our core values where when we say that we are here to educate and not to sell, right? So we are always happy to educate even if you are not planning to invest. Do understand the risk involved. Our invest education team gets on phone calls, Zoom calls, right, to actually educate people around it, and that is one of our core focus, right? And through our interaction today also you must have seen that. So very happy to get on calls and answer the questions. Really enjoyed this session. uh, Okay, questions are still coming. So yes, how long the asset will be available to buy? As long as it lasts. So this is a 15 crore asset with 10 lakh, uh, 10 lakh minimum issues in investment. So 150 units. That means at max 150 investor will be there, right? And today only we had about maximum 165 investors. So I hope for not long time. But if you plan to buy, get in touch our education team and let them know that you are planning to go buy so that they can hold right or tell you when to buy. But if you are planning to buy, get your risk covered, make the decision and make it like and then if you may have made decision, please transact faster so that you don't miss out on the opportunity. Yes. So that is another question. How long did the last asset last? Okay, the last asset last for about first 15 crore went in about 3 days, but the gold back loans and the last Dhanvarsha asset we did, it was also 15 crore asset and it lasted for 1 hour, right? So it went pretty fast. Yes, a lot of thank you comments. Really, really grateful for these. Really enjoyed this session. Uh, Wait. Yes. So if you have any query that were missed, please feel free to reach out to our education team. We are more than happy to get on calls and solve your queries. I think with this, will the education team will be available early morning before the market opens? Yes, we'll make sure somebody is available from 8 a.m. So if you have any right any questions, you feel free to get in touch, right? Just ping us on WhatsApp anytime so that in the morning we'll make sure that somebody from the team is available. Our education team has already taken note and then they'll reach out to you. Okay. I hope the session was helpful. Really enjoyed. Thanks everyone for joining in, and have a great night. Good night. Bye bye.